Good day, everybody. Thank you all for joining us here at Esgian Offshore Rigs for our third webinar of the year. My name is Matthew Donovan. I'm a head of rig market research with Esgian, and today I'm going to be joined by our senior rig analysts, Namina Kulovic and Sofia Forestieri, for our presentation, North Sea, Reversing Trends, M&A Momentum, and Regional Risk Landscape. We're going to be covering the offshore rig market in the North Sea and rig values pertaining to that market. Once again, thank you for joining us. If you do have questions during the presentation, please submit those using the Q&A feature of Microsoft Teams, and we will address those during the Q&A portion at the end of the presentation. Recording of this presentation will be made and will be shared with you this week. And just a quick note, if you experience any issues with connectivity during this, when you rejoin, you may navigate the slides at your own pace. So once again, we're joined by Namina and Sofia for our presentation today, and I will now hand the presentation over to Namina. Thank you very much.
Thanks, Matthew. Hello, everyone, and thank you for joining us today for our North Sea-focused webinar. My name is Darmina, and I'll walk you through the latest market developments, starting with an overview of the region's performance in the first quarter of this year compared to last year. So let's begin. First slide, please. Thank you. The North Sea rig supply has undergone notable fluctuations in recent years, which is a well-documented trend driven by attrition through rig scrapping and regional departures, and more recently by modest inflows as some units have returned. The region, excluding Russia North, currently has a total of 56 rigs, 30 jackups and 26 semi-submersibles, which is around 9 to 10 units less compared to late 2020. It is important to note, however, that while there were more units in the region back then, the key difference is that a greater share of rigs are active today, with fewer sitting idle compared to 2020. Currently, around 79% of the total rig count in the region is working, but this figure is expected to decrease rapidly as the year progresses, a point we'll touch upon later in the presentation. Looking at the utilization chart on the right, it's evident that this limited supply kept North Sea utilization high in 2024, keeping it at or slightly above 90%, generally surpassing 2023 levels. However, utilization so far this year hasn't been as robust. Next slide, please. Similar to the international drilling market, where contracting activity lagged early in the year, the North Sea also saw sporadic activity, with only a handful of new awards in the first quarter, primarily in the semi-sub segment and in Norway. This contrasts with the same period in 2024, when the majority of new backlog was awarded in the jackup segment in the UK. Since the end of the first quarter of 25, 2 jackup awards have been confirmed, one for a short-term campaign this summer and another for a long-term contract starting in late 25. Average contract durations in the region so far this year have exceeded those seen in 24, with both rig segments contributing to the upward trend, suggesting operators are beginning to take a longer view of their offshore activity pipelines. Notably, Norwegian operators have been particularly active in securing capacity within the harsh environment semi-sub segment, while jackup fixtures have been more diverse, with contracts spread across multiple countries in the region, reflecting the broader demand for such rigs. Recent day rates in the region's high-spec semi-sub segment remained firm, driven by a rise in demand, with one unit securing a day rate of just over $500,000 in early 25. This sustained pricing reflects a competitive market in the harsh environment sector, where operators are increasingly focused on securing capacity for longer-term projects. In contrast, limited jackup fixtures in the period offer little basis for identifying a clear trend going forward. However, as the year progresses and competition intensifies, with more rigs becoming available, day rates could face modest downward pressure if demand fails to keep pace. While the North Sea market has largely been insulated from the events related to jackup contract suspensions in Saudi Arabia and Mexico, it remains vulnerable to broader market conditions, such as fluctuations in oil prices, regional geopolitical factors, and shifts in exploration and production plans. Next slide, please. Against the backdrop of geopolitical instability and economic shifts reshaping the oil and gas landscape, Norway emerged as Europe's largest oil and gas supplier. While global rig contractors are bracing for idle periods, Norway's strong position as Europe's key supplier has supported an uptick in contracting activity, albeit confined to the semi-sub segment. This uptick is reflective of the country's broader efforts to maintain its exploration ambitions, indicating a promising outlook for offshore rig demand. Recent signs of this growing demand include the state-owned operators securing 2 semi-subs for the long term, bringing them back to the region after years of absence, and indicating a renewed interest in long-term offshore activity in Norway. Later this year, semi-sub demand is expected to return to levels last seen several years ago before its collapse in late 2022 prompted a rig exodus that ultimately left Norway with an average of just 12 active semi-subs throughout 23 and 24. Similarly, demand in the jackup segment also declined in late 22 and has remained subdued since, ranging between 7 to 8 units. However, a recent contract award for a CJ70 unit will return this rig to the market for a one-well campaign this summer. Looking ahead, the country's largest operators intend to maintain high levels of activity on the shelf, with exploration ambitions ranging from 10 to 30 wells per year in the coming period. Further adding to Norway's exploration momentum is the recent launch of its latest licensing round. The awards in predefined areas, or APA 2025 licensing round, which includes the largest area ever offered, signals continued support for exploration, with awards anticipated in the first quarter of 2026. Overall, the trajectory of offshore rig demand in Norway looks set to strengthen, particularly in the semi-sub segment. As exploration ambitions rise and the country's strategic position as Europe's leading supplier continues to shape the market, operators and rig contractors are likely to see a resurgence in activity. Looking at the chart on the right, while the increase may appear modest, after several years of no growth and given the softer outlook for the global market in 2025, it marks a meaningful shift and one with further growth potential. What we're seeing is a kind of seesaw effect. As the broader market softens, Norway is showing relative strength, highlighting the contrasting trajectories between regional and global trends. Next slide, please. Amid heightened uncertainty, rising costs, an evolving fiscal regime, and basin maturity, the UK sector has recently experienced a surge in M&A activity. Following the Eni, Ithaca, and Shell and Equinor transactions announced last year, the trend has extended in 25 with a strategic merger announcement between Neo Energy and Repsol UK. In addition, a recurring rumor of a potential merger between oil majors Shell and BP has resurfaced, although neither company has confirmed it. Several smaller transactions have also taken place, including Serica's acquisition of Parkmead UK and Ithaca's increased stake in BP's Seagull field. Also, earlier today, Ithaca Energy announced an agreement to buy an additional stake in Cygnus field from Spirit Energy. In contrast, discussions between Enquest and Serica over a possible business combination have come to naught due to market volatility. Nonetheless, this recent uptick signals a renewed appetite for consolidation, capital discipline, and operational synergy, offering cautious optimism amid broader uncertainty. Importantly, UK fiscal policy remains a key factor, influencing valuations and timing. The Energy Profits Levy, or EPL, continues to apply, eroding project economics at current oil prices. The government's Energy Security Investment Mechanism, or ESIM, introduced to provide fiscal relief when prices fall, now stands at around $76 per barrel. That's for the 25-26 fiscal year, in line with inflation. With Brent currently trading around $65 per barrel, the mechanism could theoretically be triggered if average prices remain below the threshold for 2 consecutive quarters. However, if oil prices were to remain below this threshold for an extended period, particularly falling below $60 over the long term, it could signal deeper challenges for the sector. In this scenario, companies would face heightened cost pressures, while the fiscal relief offered by the EPL and ESIM might come too late to offset the broader negative impacts on investment and market sentiment. And this adds a new layer of complexity to the UK's landscape as companies balance near-term cost pressures with the uncertain prospect of EPL relief if low prices persist into the second half of the year. All of these developments have material implications for offshore drilling. While transitions often pause immediate recommitments as companies realign priorities, consolidations typically lead to more stable, better funded drilling programs in the medium term. Larger operators can absorb risk and unlock synergies in decommissioning, exploration, and tax optimization, factors that support infrastructure-led exploration and tiebacks. Rig demand may benefit from this trend. And still, the pace of deal execution and drilling activity remains vulnerable to macroeconomic pressures, fiscal shifts, and commodity price volatility. Consolidation offers efficiency and scale, but investor caution continues to shape the outlook. Next slide, please. The Danish sector of the North Sea, which represents a smaller jackup market than the Dutch and UK sectors, for example, has seen 2 to 4 active rigs in the last couple of years. However, the 2 currently active rigs are set to roll off their current contracts later this year. And this situation stems from recent changes in operator work programs, including one early termination, which will then make both rigs available during the third quarter of this year. With no new awards yet in place, the country is expected to have no active rigs going into the fourth quarter of 25, echoing the prolonged lull in demand experienced in 2020. Meanwhile, the Dutch sector currently has 3 active jackups. One of these is scheduled to move to the UK sector later this year, while the other 2 are scheduled to roll off their current contracts. However, certain optional periods do remain available. Next slide, please. The North Sea market stands at a critical juncture, navigating between structural change and pockets of opportunity. After years of attrition-driven tightening and rig exits, a modest inflow of units has helped stabilize the active fleet. Utilization remained healthy through 24 due to tight supply, but signs of softening are already emerging in early 25. While Norway has fueled the recent semi-sub demand, other parts of the basin, particularly the UK and Denmark, are showing uneven momentum, with jackup demand notably subdued. Several contracts were shortened and a number of options were left unexercised across both rig segments, resulting in a combined loss of nearly 5 years of backlog. Note that is firm and offshore combined, though the impact has been more pronounced in the jackup segment. Due to these events, several units are scheduled to come off contract this year with no clear redeployment paths. Next slide, please. The structural shift is perhaps most visible in Norway, where geopolitical tailwinds and energy security concerns have strengthened the country's role as Europe's primary oil and gas supplier, with a renewed exploration push reviving demand. Recently awarded long-term contracts mark a clear shift towards locking in capacity ahead of 2026. Meanwhile, early signs of a potential jackup recovery are emerging, though volumes remain low. Looking ahead, several key signals will shape the trajectory of the North Sea market. The first is rig availability. With utilization expected to dip later in 2025 if no new awards are secured in the meantime, particularly in the UK and Denmark, the degree to which new awards materialize or fail to will be a critical indicator of operator confidence. Second, continued M&A activity in the UK sector could ultimately lead to more robust, better capitalized drilling programs. Third, fiscal policy and the regulatory environment remain a watch point. the UK's EPL and ESIM introduced significant uncertainty, particularly with Brent trading below the ESIM threshold. If prices stay low into the second half of 2025, this could dampen appetite for new drilling, especially in higher cost or marginal prospects. Lastly, day rates could face downward pressure as more rigs come off contract. Whether operators continue to secure forward capacity or delay decisions will determine the rate resilience going into 2026. In summary, the North Sea is shifting from a post-attrition supply squeeze into a more nuanced phase of realignment. Norway appears structurally supported for growth, while the UK remains vulnerable to fiscal, geopolitical, and commodity price variables. And that's it from me. Thank you for listening. Next up is Sophia with Harsh Environment Rig Values.
Thank you, Nermina. Hi, everyone. I'm Sophia Foreschetti, and I will be walking you through this rig values portion of our webinar. Next slide, please. Yes, so we're going to start today's presentation looking at the value development for the harsh environment segment since the beginning of last year. We start with the chart on the top left corner, where we are analyzing the Norwegian certified harsh environment semi-subs, which is the curve in the top. And as we can see, the values for this segment, they have been stable since the beginning of last year, since January, except for if we look at the end here in April this year, we adjusted the values down by 5%, and that was mainly due to the new US tariffs that were announced, as well as the announcements from OPEC Plus about the output increase for May and June. That has led the values to be averaging around 320 million today. Now, if we look at the light blue curve, that one corresponds to the 6th-gen international semi-subs. And when we compare those two markets, we can see there is a very large contrast between them, as the values for this segment, they actually have dropped by 30% in the same period. And that shows that this benign semi-sub market has been way more affected by the current disruptions in the market that we have seen. For the floater segment, those disruptions are the increased white space with lots of rigs coming out of contract without further work aligned, as well as demand being pushed to late 26, early 27. Now, when we move to the bottom part, here we have the Norwegian certified harsh environment jackups in the top curve, and we see that the values, they have developed in a very similar manner as the NCS semi-subs. We have had the 5% downward adjustment in April as well, given the same reasons. And today for this segment, the average rig value is around 194 million. Now, when we compare the NCS jackups with the premium benign jackups, we can also see that the behavior has been contrary. The premium jackups, they have also been heavily affected by the current disruptions in the market. In that case, for the jackup segment, it's been the Pemex and the Aramco ongoing suspensions. Now, when we look at the bottom curve, the dark gray curve, that corresponds to the other harsh environment jackups, so the non-NCS jackups. They have already a much lower value when compared to the NCS jackups, and that is averaging around 73 million. When we compare them with the premium jackups, we can see that the value development for this segment is very similar. It almost mirrors the premium jackup segment. So they are also very much affected by the global disruptions that we see in the jackup market. Next slide, please. Yeah, so now we move on into looking at the top 5 rig owners in the harsh environment segment for both semi-subs and jackups, as well as what is the current market sentiment for the harsh environment market. So here we have the list of the top 5 harsh environment semi-sub owners, and we can see that the top 2 are Transocean and Odfjell Drilling, and they own the majority of the harsh environment semi-sub fleet, as well as they hold the highest fleet value. When it comes to the jackup segment, we see Noble and Valaris as the top two, as well as holding the largest number of rigs and the highest fleet values. Transocean, for example, owns 23% of the global harsh environment semi-sub fleet. And Noble and Valaris, they have a very similar fleet size, around 29% for Noble and 31% for Valaris of the global harsh environment jackup fleet. Noble, however, as we can see, has a higher fleet value, and that is due to the age and the specifications of its fleet. And what does that tell us? That tells us that the global harsh environment segment is much less fragmented when compared to the wider floater segment. That it's directly related to what we see in the chart below, where we have here a comparison between the implicit values from Pareto Offshore and the Esgian Rig Values for a fleet comprised of 7th-gen drillships as well as 6th-gen harsh environment semi-subs. Those 6th-gen harsh environment semi-subs are basically the NCS semi-subs. What we can tell straight away from this chart is that the current market has more confidence in the NCS harsh environment segment than the wider floater segment. And why is that? When we observe here, the first two rig owners, we have Odfjell and Transocean. As we've just seen, they hold the largest number of harsh environment semi-subs. And as we can see from the chart, their implicit value is higher than their Esgian rig value. Now, when we look at Noble and Seadrill on the right side of the chart, we can see that their implicit value is actually lower than their Esgian rig value. And we also know that they have more floaters, like 7th-gen drillships, for example, than harsh environment segments. So that shows us that the market now has more confidence in the harsh environment segment than the global floater segment. And that is also in line with the weakening that we have seen outside of the harsh environment segment, and how that segment in rig valuation has showed a lot of resilience in the past year and a half. Next slide, please. Now, moving on into rig transactions. Here we have a list of all the transactions since early last year for both semi-subs and jackups in the harsh environment segment. In the jackup segment, we only had the recently announced Valaris 247 sale for conversion. But when we look at the semi-sub segment, we can see that most of the sales, they have been for recycling, apart from the Transocean Norge. But that one also wasn't specifically a rig transaction, but more Transocean acquiring the remaining interest in that rig. With that, what we can see that there is this growing emphasis on strategic fleet optimization and cost discipline. Now, when we also analyze the cold-stacked harsh environment rigs among semi-subs and jackups, we see that there are currently 7 rigs that are cold-stacked. Some of those, they have been stacked for a very long time, and we believe that they could be likely candidates for future recycling or conversion. With that, the Esgian Rig Values team believes that we will be seeing more transactions toward this year and the next year. Next slide, please. And now here we got to look into the market forecast. So we have here a forecast for the next 5 years for both NCS certified semi-subs and jackups. So for the remainder of this year, we do expect the values to remain stable and to start picking up in early 2026. We do expect the values to peak in the second half of 2028 for both semi-subs and jackups. For semi-subs at around $380 to $460 million, and for jackups around $220 to $275 million. Now, as you have seen extensively through this webinar with Nermina, the potential outlook for the UK, if it's in decline, we could be seeing the NCS certified rigs that are currently working in that region becoming available towards the end of this decade. And if there is demand in Norway, we could be seeing those rigs being marketed for work there. However, if there is insufficient demand, the resulting surplus, as we've seen, could lead to rigs moving out of the region, downward pressure on day rates, and all of that combined could contribute to actually a decline in rig values. So the forecast that we're seeing today could change slightly and actually decline past 2030. So the main message here is that the harsh environment rigs, especially the NCS certified rigs, they have been very resilient and insulated from global market disruptions. However, they're not completely unaffected by the UK dynamics and the regional developments in the region, and that could change the forecast that we're seeing today, especially into the next decade. With that, I end my presentation. Back to you, Matthew. Thank you.
Thank you very much, Sophia. And thank you both to Namina and Sophia for the presentation today. And thank you all for joining us. As a quick reminder, we will be making a copy of this presentation available, recording available to you later in the week. We're Esgian Offshore Rigs. You can see on the screen there contact info for our analysts and for our commercial team if you're interested in learning more about our products, rig analytics and rig values. I think now we're going to turn to the Q&A portion. Once again, you can submit questions via the Q&A section. If we do not get to your question during this presentation, we will reach out afterwards. So I'm going to start off with a question here. Do you see attrition influencing the supply picture in the North Sea further in the coming period?
I'm assuming that one will be for me. That's an interesting question. Thank you. And a relevant one, of course. So like I mentioned earlier in my presentation, there's been a lot of that in the North Sea in the last few years, especially, in the last 4 or 5 years from 2020 to up until now. And like Sophia mentioned, there were only last year 4 units were sold, all 4 semi-subs, all 4 UK from the UK, and sold for recycling, meaning they left the drilling market. So taking all of that into consideration, there is limited room for further attrition. There is room, but very limited, of course. So, we do have cold stack units, for example, a few of them left in the North Sea region. A couple of units in Norway, a couple in Denmark. Then there's also one K-Fels class jackup stacked in UK. So all of those, most of those, aside from one semi-sub in Norway, have been idle and cold for quite a long time, for an extended period. So those could technically be candidates for leaving the market. Although there is another interesting example, and one rig whose fate is currently uncertain, is one that left the North Sea for an SPS last year, but then that was paused due to loss of a contract, so leaving the fate of that unit uncertain. So there are some candidates, like I already mentioned, but definitely not to the extent that we've been seeing in the last several years.
Right.
Hope that answers your question.
Well, thank you. And follow-up question there, we've got, do you expect the recent licensing round in Norway to translate into meaningful demand in 2026?
In 2026, no. Like I mentioned, the awards are going to be announced early in 2026, first quarter. So, the winning operators will need some time to, devise their plans and, move forward with their work programs. And every license has, it's different, could have different works, different terms and obligations. So it depends on the license and depends on the operator, of course, and the speed and the progress of that whole process. So 26, no, but in the latter part of the decade, several years back, for sure, and then also given the scale and consistency of these rounds in Norway, especially when you consider the situation in the UK, where, as probably everyone knows, the new government said there will be no new licensing rounds. So exploration in Norway is alive and well. And this latest round, as the ones before, signal a clear commitment from the government and operators to sustain exploration. So then, if only a fraction, considering that, according to the government, the region, the area that's been offered in this latest licensing round is the largest so far. Considering all of that, and if only a fraction of that would translate into, concrete specific exploration wells and plans, that would be definitely a meaningful demand towards the end of the decade in Norway.
Okay, thank you. We do have additional questions, but we're coming up to the end of our time period now. So to everybody who asked those, we will reach out to you personally and with answers to those questions via email. Once again, thank you everybody for joining us at Esgian Offshore Rigs for our presentation. Appreciate your attendance today, and thank you again to Namina and Sophia for this presentation. Once again, thank you all, and please look out for our webinars in the future. Thank you.
Thank you, Matthew, and thanks everyone.